You're watching us here on Chartbusters. I'm Mangalam Malu. With me, as always, Nigel D'Souza. We'll talk about the markets in just a bit. But for now, Bata, that was the company that reported a softish third quarter performance, mildly below street expectations as well. But the company has made some interesting announcements. I spoke with Gunjan Shah, who's the managing director and CEO of the company, to discuss their plans going forward and the third quarter performance in detail. First up, tried to ask them about the demand environment, which he said that was weak at the lower end of the price point, as a result of which the stock at the low point of trade.
We do see some kind of a divergence. I think on the positive side, the premium section of the business, which is in the price points of 1,000, 2,000 and even higher, are doing really well and actually leading the growth for us. That is also signified by brands like Hush Puppies, Comfort, sneakers, even our new washable footwear, which is floats, that is doing exceedingly well. And combined together, all of them are growing in the range of almost 20-30% higher than last year and even above, obviously, pre-COVID levels. However, there is a certain amount of sluggishness that you see in the price points which are below 1,000 and especially below 500. And that has seen some amount of sluggishness right from about September onwards. I think it's a cumulative effect of the kind of inflation that consumers have seen overall and the price increases that we have taken to manage this inflation from a footwear perspective. So hopefully that should even out, but that is how we see it right now.
You know, I'm looking at some further details in your numbers. Your overall volumes are still 5 to 6% below pre-pandemic levels. Is that largely on account of the weakness that you're seeing in the lower price points? Where does it go from now? What are you doing to ignite that, demand once again?
Yeah. So, see, there was at the start of this year, which is January, we did have also a GST impact besides the raw material inflation. Now, combined together to manage the business, we had to take in some amount of price increases. That does have an impact on volumes for a certain period of time. We are hopeful it will wane away as cycle base takes over. The other thing is that for the second half of this year, cumulatively between, let's say, July to December, we did see positive growth even higher than pre-COVID volumes. But for this quarter, yes, it was 5%, largely by this mass category sluggishness that I talked about.
What are your thoughts on growth going forward then, and even margins? Because now the raw material inflation is somewhat on the wane, and you are seeing some sort of recovery even in the lower end of the spectrum. That's what all the other FMCG companies are saying as well. Could you, concur with that or, counter that? And what happens to your margins? Do we see further improvement back to the pre-COVID levels of 26-27%? Any inkling on by when you get there?
So we don't give forward-looking outlooks, Mangalam, but however, I think commenting on some of the levers, raw materials, while they are a little different from some of the FMCGs, but we do see some flattening out. It's early trends yet. We would like to see it for a longer period of time, but I'm sure we should see those benefits. We have now, for the last almost 6 months, now staved off for any further price increases. So that cycle base should basically start impacting volumes positively going forward. So we'll wait and watch on that front. As I said, the demand on the premium side is pretty strong, and we are wanting to make sure that's in line with our premiumization strategy, and that continues. So that should keep fueling growth for us going forward.
What's the timeline that you have for the coming together of all these initiatives that you're taking? You know, we're talking about you expanding your stores via franchise, you shutting non-profitable stores at the same time, looking at increasing your ad spends, repositioning your brand, so to say. All of that brokerages believe are steps in the right direction. But what they wonder is by when do they actually, bear fruits? Do you have any timelines on that?
No, we see internally, we see signs of that showing us, tangible shifts in various metrics that we measure for. So premiumization is working. We see ASPs going up. Even in our, so for example, in our Hush Puppies, our ASPs are 4,000 plus, and that's growing strong. Our sneakers continues to drive growth for us, and therefore is showing a significant delta versus our overall growths. We also see a significant amount of newness in our portfolio across the range, right? And whether it's in terms of fashion quotient or even in terms of stylishness, that has gone up by a significant index across, festive wedding collections that we launched, the pop colors and sneakers, floats range that is extremely attractive. even in our school business, we are bringing up a significantly shift in the kind of newness and fashion quotient from a sporty range. So all of that is showing up in indices. We are seeing consumer feedbacks, the average age of consumers coming down for us. So all of those are showing. I think that clubbed with the entire expansion strategy that we have been on for some time. Last quarter, we saw the largest ever addition of franchise stores. It's a significantly capital efficient model. And all of this hopefully augurs well in the medium term in terms of deliverable back to the business.
Can you quantify what is augur well mean? I mean, are we looking at mid-teen sort of growth for the next financial year with improvement in margins? That's one. Not asking you for specific guidance, but is that a reasonable assumption? That's point number one. And you've reached over 2,000 stores now. I'm told that you're looking at the apparel category as well. What are your thoughts there?
Yeah. So as I said, we don't give forward outlooks, but the objective is towards making sure that we get back to attractive and strong CAGRs with sustainable and profitable growth. And some of these, both premiumization, getting the portfolio newness, as well as making sure the expansion and the efficiency should kick in. We are also backing this with significant investments. Last year saw the highest ever marketing investments that we have done. That will continue. We are also significantly involved investing in digitization, and that should basically flow through in terms of efficiencies as we go forward. Sorry, I missed your last part of the question.
Apparel. You are looking to get into apparel.
Right. So, see, apparel, we had started off on a project on apparel. It's a very attractive category. It's very adjacent to the kind of consumers who walk into our 2,000 odd points of sale. Right. And that has an attractive both in terms of growth as well as in terms of profit pool. We had started a certain pilot pre-COVID. We had kept it on halt. We are now aggressively restarting it. Watch this space. Hopefully, we'll have an update a few months down the line.
All right, we will await that. If you could tell us, what's the kind of investment that you're looking to earmark on that and all, along with the kind of revenues that you are expecting, any broad outlook right now before we get to fine-tuning those numbers would be good. And finally, the last time we spoke, you had an FY25 target, given the average revenue that your every store does, etc., of close to around 5,000 crores in overall sales. Is that still on the cards?
That was a number that you had back calculated, Mangalam, but I wouldn't say it's out of reach.
All right. And apparel, how much are you looking to invest in it?
It's too early. As I said, watch this space, but we are looking at second half or most probably end of the second quarter of next financial year to make sure that we make our entry. So we will have a much more detailed update on it down the line.
Right, that really is the big headline. Footwear maker Bata is looking